Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I hope you guys are doing well. I am trying to stay out of the heat like everybody else. Let's jump right into our housing market update for the week. I'm going to go ahead and share my screen here with you. I'm going to have another video, just too much to pack into one video. I'm going to have another one coming up where I'm really going to dig into a little bit more of national and local numbers here, just to kind of put things in perspective for people, since we're kind of in a different market than we're used to kind of help dig into it a little bit more, but a little bit more granular. I'll do that in a separate video. But this week, kind of the popular version of what's going on for this video. We see, we had the Fed's meeting a little over a week ago, and we're talking about inflation was cooling, and the rate of increase of inflation was cooling. We also saw the unemployment numbers were up, and they are starting to message the idea of rate cuts coming here in the next couple of months. So we'll see how things go. But U.S. Inflation cools again, potentially paving the way for the Fed rate cuts to come soon. That'll affect the bond market, 10-year Treasury, and then that'll affect mortgage rates. They're talking about it cooling for the third straight month. So they may end up cutting those Fed fund rates soon. That's all well and good. So we see that the latest inflation readings are getting them closer to that 2% mark that they want to be at, and that would definitely do it. But they weren't ready to cut anything yet. So, really at this point, with the unemployment up, the rate of increase of the inflation, you know, going in a direction they wanted to, there's really no excuse for them not to do this except being slow and old, which they are at the Fed, and we need to kind of get things moving here in the market. And we have things like the permits and all that sort of thing being down right now, which is not good for the market. So what we want to do is we want to kind of keep things moving along, and they need to start getting on the stick with that. But this article goes on to say this confirms that there's little chance of inflation reaccelerating and that it's time for some rate cuts from the Fed, said Luke Tilley, chief economist in Wilmington Trust and Wealth Management Firm. He noted that the measure of rent and homeownership costs cooled significantly last month, a long-awaited development. Rental prices typically don't change much from month to month, he noted, which means that the lower or slower price increases in June will probably continue. So usually have a lag effect. Is usually waiting for those rentals numbers to catch up. It's 43% of what they look at in the inflation numbers. It's baked in. It's kind of weird and crazy how they do that survey of rent, so what people think that their home is worth and all that sort of thing. But in any case, that's what they look at, and it makes up 43% of the entire inflation numbers that they're looking at. So from that standpoint, we are seeing, this idea here that, that rate of increase has slowed. Now, the other thing is we saw, we've seen that the number of permits for apartment complexes, and I'll dig into this more in a separate video, but the interest rates for, I'm sorry, the rate of building for apartment complexes, which takes about 21 months to get done. That has slowed. The apartment boom is over. Also, single family home permits down. So those permits for both of those sectors are down at the same time. Plus, you have unemployment going up and the rate of increase of inflation going down. So it's kind of the perfect storm for them to, stop the nonsense and all the fancy ways of trying to be clever and stuff that they're not, and just get things moving along. Because what'll happen is, if those permits aren't going, you're going to have construction workers laid off, and think of those as kind of also building materials stop, the supply chain stop, and that supply chain of workers, the construction workers stop for those sectors. And then when you need them to ramp back up in order to make sure you've got enough supply so prices don't go up, that's a whole nother issue. So they've got to get going on this. Otherwise, they're going to cause another issue of not having enough, which we don't. We already don't have enough housing supply. What new supply really is new home builds. For rentals, it's new rental projects. For homes to buy, it's brand new homes that are being built. So they can't sit on this anymore. They really need to get moving on it, not just because, people want to save money and all that. It's just overall, the overall economy and the thing that they were trying to do by taming inflation, they're going to cause another issue with supply and demand. So there's really no excuse for them not to, looking ahead. These are the 2024 meetings. They just had June 11th, 2nd, and 12th, July 30th, 31st. There should be no reason for that. Now, their messaging is good so far in that it has helped to bring down mortgage rates, which we'll look at in a minute, because it's affected the bond market and the 10-year treasury. Uh, but a lot of people are saying it's probably going to happen in September. There's really no reason for them, quite frankly, there's no reason for them not to do it this month. But in July, there's really no reason. And honestly, they should just get it done now rather than waiting. But that's just how they do it. They're slow and old, and that's what they're going to do. And they probably, knowing them, won't do it till September, but July or September, it's going to happen. Now, what does that mean? 25 basis points on the Fed's fund rate. So not a direct correlation, but it'll affect the bond market enough, again, to give us another benchmark for mortgage rates to drop more than they already have in the past week. Right now, let's save that for later. Right now, we see mortgage rates holding near 5-month lows. There was a slight increase today, but mortgage application volume bouncing back as rates fall. And we see, with not only home purchases, but refinances gone up a little bit, which is great. Nothing crazy, but just a little bit. And then, for today, the 10-year was up just a little bit. MBS prices are moderately weaker so far today. This downward movement of MBS may result in higher mortgage rates for today. So they went up slightly from where they were, but seeing that the overall trend is gone down is a good thing. Because we were up over 7 again at one point, but we were kind of hovering around that 7 mark. But now that the messaging was coming out, we had some volatility today, and some drifting off into this issue of today. But overall, we were right around that lower, right around 6.8 for that drop since the last Fed meeting. So that'll be good. That's a good trend. Now, the overall housing market for the Phoenix area for just active, not counting what's under contract already, but what's active is a little over 18,000 homes for sale. And that's been, again, kind of hovering around that, 17, 18 mark, right around there. We've got 103 days closed on market. That is gigantic. The median agent days on market right now is running at about 34. We're at a month supply of 3.6. So median's always lower than the average close days on market. I'm sorry, it's 34 at contract. 34 at contract. Anyway, that's totally different than closed days on market, but it's 103 closed days on market. 3.62 month supply. That means for the Phoenix area, we're in a balanced market. Anything over 3 really for us is balanced. We've talked about that a lot and how that kind of works. The absorption rate is lower than normal, at 27.62. Average list price is at 758, and average sales price is at 586. The actual selling price is at 586. They're kind of hovering around that area for a while now. We are at 97.3 list to sales price ratio. Usually we like to see that just over 98 on that index. And then the active properties, Up a hair for the past week. Obviously, the numbers shifted a little bit from what I showed you earlier. Pending sales are down. Okay. Again, just not as many people in the marketplace with with the higher rates, but doing a little bit better as far as what we're seeing coming into the marketplace. Closed units up 21.7%. So that's good news, but still those numbers are not, where we want them to be. Usually we'd like to see, a lot more properties coming down the market, a lot more properties getting under contract and closing out as we've gone over a million times before. Short sales, again, percentages have gone up, but the overall numbers are really kind of nothing. 54 short sales, 37 lender REO type properties, and then you've got HUD at 5. So, when we look at the numbers and kind of break it down again, the majority of the inventory that we're looking at really is, from the lower ranges, up to 199,000 is 6.1. Then you got up to 399,000, another 26%. So right there, you've got over 32%, and then another 32% from 400 on up to 599. So that makes up about 64, a little over 64% right there. And then the rest of it, so that obviously within context of the numbers, that obviously gives us where we are right here with the average, sales price at 586. Okay. Our luxury market now is, going to be closer in a range of $1 million. I remember not that long ago where it was about 500,000. But anything, pretty much over a million for us right now, with the increase in prices over the last few years is going to be $1 million. So, anyways, that's kind of a quick rundown on those numbers and how they kind of run into these other numbers up in here. The Cromford Market Index right now um, is at 100 right here in the middle. So anything under 90 is a buyer's market. Anything over 110 is a seller's market. Right now we're at 100.9. Okay, so basically for all intents and purposes, we are in a completely balanced, right in the dead center market. Okay. We can also see that by supply and demand, which affects everything. Always think supply and demand, guys, whenever you're talking about any kind of product or data. Okay. So you've got demand here at 75. That means there's 25 under where demand should be on that point system and this index. And supply is like right about there too, right almost right there too, at 26 or 25 and a half, lower than it should be on supply. So when those numbers are exactly the same, which basically they almost are, that's why we got a little, a little bit above that 100 mark here. You are in a balanced market. Okay, so that's basically how we're looking at it here from these numbers. So the percentage of closings with seller paid concessions is at 51.7%. 51.7%. Going all the way back to kind of where rates just started going crazy for us. We go all the way back to like February, um, in May. Let's look at May of 2022. Okay, just to give you kind of an idea where we were. That was about 10% paid seller concessions, 10% back in May of 2022. And it's when we saw the interest rates start to go up and affect the whole market shift in the Fed trying to tame inflation that way rather than how they should, which would be more economically sound government and what they're spending, but that's a whole nother story. Number of price changes per week. We, have seen the number of price cuts right at about 2,500 price cuts for the greater Phoenix area in the last week. Okay. With a number of just actually it's 2,436 to be exact. So almost 2,500. Um, from all the numbers that change from the residential resales price changes. Okay. That doesn't even include price changes in new builds. So It's quite a bit of price changes, guys. That's really high. Okay. Annual median sales price. We're at 440. Last year, about this time, we were at 430. That's the median sale price. We're at 440, 440,000. Last year, 430. So not a big change there, right? If you kind of aren't getting this yet, we're kind of in a, I would like to call it stagflation. Things are just kind of hanging there, kind of flatlined from the sustained longer period of time with these higher interest rates. Again, historically, right around the average rate. 2 and 3% rates are not normal. They're anomalies. Don't expect them to come back anytime soon. Um, we do expect rates to drop. They're not going to probably drop super fast. Like I said, we're probably going to see 2 rate cuts by the end of the year. That's what they're predicting at this point. Again, we should see it July, or the way the meetings are. There's no meeting in August, so then it would be September would be the next one. So by September, maybe the end of July, we'll see it probably 25 basis point cut. At the end of the year, by the end of the year, we'll probably see one more 25 basis point cut. So nothing crazy, but it will definitely have an indirect effect on those mortgage rates. Um, Again, if we were, let's say, you go with a mortgage broker today, just with the straight rates, you're going to get 50. I've seen 50 to 100 basis points lower, depending on pricing from other places. Those are just the national averages on the numbers we gave you earlier at that 6.8. Also, there are buy down programs. I keep stressing this. People can get lower rates now. Builders are offering lower rates now. We saw with the concessions, well over half, 57% of resale home sellers are paying seller concessions. That means that they're basically paying out money to get you a lower rate. What kind of rate can you get? Well, starting right off the bat, that first year, you could be in a buy down situation around 4%, some cases 3.5% we've seen. The second year would go up a little bit, and then the third year, if you're in a 3-2-1 buy down, not a 2-1, it would go up at one more time. And we're only talking small percentages. So, let's say you went worst case scenario 3.5 to 4.5 the second year, and the third year it stops, let's say 5.5. And you're good. Now, if you want to refinance later, if rates dropped below any of those marks during that period of time, so after that third year, it's fixed, or second year, it's fixed, depending on which program you go with. But if rates drop below that any period of time, you can refinance with not only no out of pocket costs, but because the seller or builder paid those buy downs for you, that money sits in an escrow account with a title company. Okay, we use title companies here in Arizona. They have what are called escrow accounts. It's where all the money runs through that are, buyers, getting their loan funded, and it pays the seller and back and forth with all the prepaids and everything. It's where all the money runs through. So if the seller is paying that out, that money sits in there, and it will sit in there until you use it for a refinance. So not only do you not have any out of pocket costs, but you have zero out of pocket costs, because now that money can be used to go ahead and refinance when it makes sense. Okay. So it's kind of a no brainer if you want to move, if you can afford to move, have to move, whatever, upsizing, downsizing, you're moving for a job, family, whatever. Um, you know, I'm telling people right now, and we can go over the numbers with a loan officer and talk about how it makes sense to go ahead and buy now, because what's going to happen, guys? I'm warning you, trying to warn you, as a friend, and doing this for a living. What's going to happen when those rates do drop to a low enough level, especially, let's say sub 6, when you see those on, the numbers I give, those are, again, the average national rates. Okay. So you're going to get lower rates than that typically, especially if you're with a mortgage broker. Um, so even with no buy downs, that's going to bring in a flood of buy for every 100 basis points or 1% difference in a mortgage rate. You're going to have 5 million more people flood the US market. in demand and home buyers flood the market, okay, or that can qualify to get into the market now where they couldn't before. So even if half of them do something, okay, and right now I can tell you there is so much pent up demand. There are a lot of people who want to move, uh, to different states or want to move, to a smaller or bigger home or whatever. They don't know all the ins and outs of this. They don't know that they actually could get a lower rate now and all the things we've been talking about. In some cases, they could even assume somebody with a 2 or 3% mortgage rate. There are so many ways to get, these lower rates right now. There is even down payment assistance programs, and there's actually some pretty good ones, even with as high as the rates are, because typically with those programs, you're going to get charged a little bit more. But in any case, there are options. You have options right now, and you can do it if you know how to. You can do it without having to pay these higher rate and payments. Okay. So as far as how it breaks down on this market index from Crawford, first of all, they're saying, they've come out and said from Crawford, same thing we've been saying right along. Unless we get a wave of, new inventory from somewhere, even though maybe things are a little bit flatter on pricing, and sales are lower than we want, we're not really going to see anything in the way of a crash. Okay. um, when we talk crash, first of all, those numbers have to really mean crash like they did back in 2008. And also, you have to have what you had back then. You had poor lending practices because of too much inventory, because the builders overbuilt back then, and they're not doing that now. Matter of fact, they've dropped their permits again. Like I mentioned earlier, dropped the permits, and we're going to have an inventory shortage for a very long time until we get these things ramped up and we have lower rates for a longer sustained period of time. So better to not have those extremes anyway, and to keep the rates maybe not as high as they are now, but a little bit elevated from what we were used to before, only because it'll keep things kind of moving in more of a normal and not in a not this crazy anomaly type years that we've had, whether it be the extreme of the crash where you had poor lending practice because of too much inventory, 4 million homes across the country, where now you have maybe a million and half of those are under contract. So you don't have enough supply. The Phoenix area, 56 to 58,000 homes at that time, where now we have, like I showed you, 18,000. Even if you include those numbers of what's under contract now, they aren't really that much higher than that. Like I showed you earlier, how many properties are under contract. So it's really, it would really take this flood of inventory that just is not there, and really new inventory. So new inventory is from the builders. They're not doing that. They're not the March of Dimes, right? So um, anyway, when we have 9 cities right now that are in uh they're in these areas of seller markets. Okay. Chandler still tops the list at 181 on the Crawford Market Index. And at the bottom of those 9 is Scottsdale. We have Peoria and Paradise Valley. They are in balance markets as far as these cities proper and how they come out on this index. And then we have let's see, Surprise, Goodyear, Cave Creek, Queen Creek, Maricopa City, and Buckeye. Those are all all buyers markets. Okay. So one other thing that Crawford gives us is what's called a contract ratio. And if it's 60 or higher, that begins to put you into a hotter market. But most of the valley outside of Tolleson, parts of small part of Levine, uh, a little part of Glendale, Peoria, um, and then North Phoenix, and a little bit of Tempe and Chandler. Those are going to be where you'll see a hot market. Everything else is really cold or balance or warm at best. So right now, we don't see any kind of issue with crash, but we also don't see any kind of an issue with pricing getting out of control. So, it's just kind of a, a very stagnant, flat line, marginal, very marginal increases in pricing. So it's that time period where you can actually get in and get some deals right now. Okay. You can, more importantly than getting a lower price, unless you're paying cash or all cash, is getting those buy down programs, those buy down rates that the seller or builder are going to offer you right now. Over 50%, 57% of the time right now. And so from that standpoint, it's a great time to buy. Excuse me. If you are thinking about, if you need to sell a property, think of it this way: you kind of miss all the crazy rush. If you find a property you like or need to move, you kind of miss all that rush that we're going to have once rates do drop. You can gain the equity in the new property rather than the property you want to get out of, and kind of get that over with now and not have to deal with all the hassles. Plus, it's going to be kind of a wash, because even though you may get a little bit less than you might have hoped on your property right now because of the way demand is and the rates are, you can get a good deal on the property you're purchasing. So it's super important to price your properties correctly. When you get a pre-approval from a lender, they're giving you a pre-approval, typically in what I like to call price brackets or round numbers. Okay. You don't get a pre-approval typically from a lender that says you are pre-approved for 553,062 cents. Okay. It doesn't usually work like that. Like you may get something that says pre-approved for 550,000. And it'll tell you, if we're getting close to the top end of that, let's talk. Let's look at the property taxes and insurance and HOA, if there's solar leases and all these different things, to figure everything in on the cost and what you're actually going to probably qualify for. Every, area is going to be a little different for insurance. Everybody's going to, taxes from one property to the next, even next door to each other. All those sorts of things you've got to look at. There's principal, your interest, your taxes and insurance, HOA, solar leases, all that stuff. Sometimes land leases. The lenders have to take that all in consideration, but they're going to give you a round number, and then we'll kind of take it from there. We plug that into the search. So it's the same thing on the reverse end when we put it into the portal for the search, okay, as a buyer, using those round numbers. Typically, again, it's going to be up to 550. So that's up to 550 is kind of a even number, right? And I call them price brackets. So if I price, a property, let's say at, oh, I don't know. Let's say somebody's looking for a property from 550 to 600. Okay. Great. So you price your property at 549.9. Think about that. Are they going to see your property? No. You know, uh, if you're selling multi-million dollar homes, like, $1 million listing, New York or LA, we can play those games all day long. Okay. Because it's a little different type of market, especially in New York, because their MLS maybe is a little bit more limited, especially in certain areas. So they have a little bit more of an exclusive listing. Plus, they're not set up with NAR, which is a whole nother thing. But the searches and the way the properties are, pocket listings, things like that, that they can do there, may be a little different. Same thing with the luxury market in LA. There may be a little bit of a different thing going on there. And there's a lot of, lot more in the way of exclusivity, especially at that level. Okay. Um, and there can be at lower price points too. I mean, I've got people who I know want to sell right now. I know people who want to move on right now or are thinking about it. They're just not quite sure if they want to do it yet, even though we go through all the numbers and everything. And that's fine, but I know that's there. So, um, when you're, same thing goes when you're going to list the property. when you're going to list a property, okay, you gotta price it so that it's in the price bracket that people are going to be looking in. Okay, we're not selling soup cans or boxes of cereal. Okay, that's a little different again too from the whole marketing mindset of selling selling those things. So, do I want to miss a whole segment of buyers because I got wanted to get clever and cute about pricing it like they do $1 million listing LA if I'm pricing a middle income, let's say, property that people are going to be looking at because I priced it at a $1 or $100 difference because I wanted the 9999. Seems a little silly because new people come into the market all the time. And if they're missing your property because of that, that would be a shame. So you could either be the best deal in the MLS, depending on which end of the spectrum you are in that price bracketing, or you could be the Taj Mahal of that price bracket. Okay. So and we've got to make sure that we're pricing properties aggressively right now. So that's really what I would tell you up front, and be totally honest with everybody right now with the way the market is. Um, People are getting very picky when they're going through homes. They're kind of thinking, do I want to really have to do any work to this? Because everything is so expensive already in life with the inflationary factors that we have. I know the rate of increase has slowed, but all that rate of increase that we had before, you'll hear 9%. If they figured it the old way that things used to be figured with, all the extras of interest rates and everything, you'd be talking a much higher rate of increase of inflation. Also, if you look at, the way they figure the rent thing, like I mentioned earlier, which is 43% of the inflation, and you figure that alone with what people are paying in interest, people are paying in home prices versus what they were talking about for rent, you're talking about a much higher inflationary factor and rate of increase then and now. So, you know, people don't have a lot of extra money to play with. They just don't. So, you've really got to, price the property accordingly. But look at, again, like I mentioned earlier on, look at what you, yeah, those couple of years, property values went up 40, 50%. Okay, great. Depending on your community and area you're in of the valley. But the average increase for the greater Phoenix area is about 5 to 6% a year. So again, looking at it from a sane point of view, not all the figuring in an anomaly every year. We're looking at things normally. We have to look at, boy, if that was just kind of a normal increase, I'm still way over that, even if I got a little less. So and when we're selling a property or selling anything, whatever it is, whether it's a vehicle, a house, whatever, we have to look at, what are people willing to pay? What condition is it in? What's the market conditions? How much supply and demand there is, and be real with ourselves about all that. Okay. And just again, when you do improvements to a property, which you have, sure, that'll help with value a little bit, but a lot of times, depending on what you've done, it may just be a factor of, hey, I could sell this property a little bit quicker. Okay. Because people are thinking I don't have to do much to it. But when they come through a property, they're going to be very picky. If there's any like, I don't know about this part or that part, they'll just keep looking. They'll just go on and keep looking for what they really want. Unless it really makes sense for them to do it because the price and concessions make sense, or you made enough of a spruce up to the property when they actually walk through it. Okay. Because pictures don't make anything. I mean, I've seen pictures online that I'm like, I get into the house and the room doesn't look that big. The color on the walls is totally different. Things have been digitally staged, photoshopped, even though they're not supposed to, even with unless there's some kind of permission given from our MLS. But that really is something that factors in a lot too, and then you just really turn people off. So there are some really good strategies, but you want to make sure you're doing strategies that are actually going to work, not strategies that are going to turn people away. And it's important to, my wife and I got in this business back, after we purchased a home in 2012. And it went through some crazy stuff back then with an agent that really didn't help us that much in the way of consulting, as we felt should have been. And that's part of the reason why we got into doing what we're doing. And you know seeing that people out there do get taken advantage of. They do get kind of shined on with letting them hear what they want to hear so somebody can just get a listing. We would want to get the property sold. We want to be totally upfront, and make sure that we're not wasting uh, valuable assets, for you, and carrying costs and stuff. We want to make sure that the job gets done right. So, guys, I am going to do a separate video on inventory. Okay, and that is going to be pretty interesting. Not only on inventory, but it's going to get into some of the other facets of the market that we're seeing right now. Whether it be home values, equity, and stuff like that that people have. The number of price cuts across the country. Where is the supply actually the highest? Where's it coming from? What are the hottest markets? I'm gonna be doing another video on that, just to give you a little bit more idea on some of this, and a little bit more context on what's going on. So if you guys have any questions at all, love to be able to answer any of your questions. We love questions. I want to go into that a little bit deeper because we've had a ton of questions from a lot of people who are looking to buy and sell recently. And a lot of people just trying to figure out what to do. And we're happy to go over that. You're not wasting our time. Also, don't mind at all doing that or stopping by and giving you our opinion. Before you do anything to your property, please consult an experienced real estate agent that knows what they're doing. Um, and you'll save yourself a lot of headache, a lot of problems, and a lot of money. And just know that right now, is a great time to actually get a deal, though, from those standpoints that we talked about. So, guys, I hope that helps. If you guys have any other questions at all, feel free to reach out to me anytime, and we'll talk to you guys soon. Thanks. Have a great weekend.